Good afternoon, everybody, and welcome to this edition of our weekly Think Tank for Monday, 1st of Feb. My name is Carl Kapalingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we recap the week that was and look to the week that will be. We'll do all of that after we talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. 4 fantastic reasons why you should make sure your next ASX share trade is with Think Markets. The agenda for today is to have a look at the key market moves from last week. Plenty going on there, not all to the good, unfortunately. We'll check out the COVID situation, see what's going on with economic data, have a look at some of the key broker moves during the week, see where the value is in the Australian market, and check out some technical factors before we look to the week ahead. It wasn't a fantastic week that was, unfortunately, down 3.17% for the ASX200, but much sharper falls within the market. Energy down 10.6%, materials down nearly 7%, technology and gold down just over 5%, leading the losses. But a few other sectors there not doing so well. Also escaping the carnage, discretionary managing to just squeak out a 1% gain. Healthcare up 0.5%. That sector tends to benefit when the Australian dollar come off, and it did. And then the staples, which is a very defensive sector, up a 1.77%. Healthcare also quite defensive. Utilities, another defensive sector, up 0.7%. So we can really see those themes that were with us for much of 2020. That is risk on. So, cyclical stocks like materials and energy, high flying growth stocks like technology, they're all doing very well. Defensives like utilities, healthcare, and staples to a lesser extent did unperform, and we've seen that switch around last week. The ASX200 volatility index up 20%. Moving to the chart now for the ASX200, and of course as we speak, now this is as of Friday's close, but as we speak we have seen a move down to about 65.17, and we're currently up around here. We did see some support coming in at this level here. 65.11 is a past support level, and we tend to see past support levels act as future support levels. South of that though, 64.71 and 63.77 are two levels I've identified in particular as areas of support. But we will see how the price action comes through for the rest of the week. If we can see a continued rally, then there is a very good chance that we've seen the pullback, and that's all we're going to get. If we don't see something like that, and I'm going to draw it out here because I don't want to confuse the issue, but if we see something more like this, a candle or bar more like this, where we go up in the morning and then come down and close near the lows of the day, that would indicate that we might actually complete this move down over a longer period of time. I do think that once we get back to this long-term uptrend here, we will find lots of support, and we may see the market sort of rally from there and go high, which is what I think it will do in the medium term. But we do know January, I've said it a number of times in these sessions, January and February tend to be seasonally very weak periods for the markets. And then March, April, May tend to be very strong periods for the market. So we are on watch with a big exclamation point there for the ASX200. I think caution is required in the short term, and that caution was definitely experienced across the region. We saw falls of 3.5% for the Nikkei and the Shanghai Composite, and nearly 4% for the Hang Seng, as those markets, which were doing fantastic prior to last week, pulled back quite sharply. Dow Jones, the S&P 500 and the Nasdaq in the USA down between 3 and 3.5%, and the VIX, the volatility index in the USA, that is a massive spike up about 50%. Still well off those COVID highs, however. Looking over to Europe and the UK, we've got the UK down 4% and slightly more modest falls in Europe of around about 3%. And when markets go risk off, we tend to find that metals tend to suffer weakness, and we saw that on the London Metals Exchange and also on the iron ore markets as well. Iron ore down 6.7% in China, certainly undermined the performance of shares like Fortescue, BHP and Rio this week, and in the US dollar price it was down over 8%, so sharp falls. The rest were weaker, apart from tin, which managed 2.85% gain, and silver, which was up over 6%, and it's up as we speak. I'm going to give you a price here, another 4.7% to 28.27 as we speak, because of all of this talk that the Reddit gang of traders, and they are the traders who rammed up the price of GameStop during the week last week, that they are now going to target silver. It is all speculation and hype at this point in time, but I do note that silver chart was looking pretty good prior to this hype, and it was conducive to going up anyway. So if this just sparks that next rally, then so be it. The energy sector we saw was down about 11%. Crude oil prices weren't that bad. In fact, natural gas prices were actually up. And I think it's just more of a function of this switch in the markets back to risk off. So just a risk aversion at the moment. And that's certainly evidence in the Australian dollar. It is potentially the key risk on currency out there, certainly amongst the majors. And we saw that fall by 1% as the US dollar index bounced back 0.4%. Bond yields, we saw Australian bond yields creep up, but US bond yields crept down, so I don't think we'll take too much out of that. In terms of how we're tracking this crisis versus the last crisis, and this is just a little bit of fun to sort of see how one crisis compares to the other, and certainly central banks and governments tend to react in similar ways, and we see markets bounce back in similar ways, and I wonder if this little down blip here is akin to that little down blip there. Certainly, once we did that, we did find a low and then go up and make new highs again, but we'll keep an eye on that. You're probably thinking, well, what was the reason for those sharp falls last week, Carl? And I don't have a really definitive answer for you. There was nothing, no smoking gun, I guess you would put it. There were a couple of small factors out there, but nothing really in particular, and certainly not on this chart here. And this is the chart of COVID cases, daily confirmed COVID cases, or the 7-day average, I should say. And they are still heading down, and that's heading in the right direction for markets. So it wasn't over there. Let's see if it was anything particular on the economic data side. Well, NAB Business Confidence Survey for Australia came out during the week, and we saw current conditions, so that's the light blue line, continuing to head higher and on a V-shaped recovery. So that's all good news there. Certainly expectations came down somewhat, so they were at so confidence was at 12.67 and came down to 4.47, but still in the plus column. So that's somewhat encouraging. But I don't think that's any reason to spook the local market. We saw inflation come out. Certainly markets are very attentive to inflation at the moment, and that came out at 0.4% for the last quarter, and that was below expectations, a little bit up from the previous quarter, but certainly below expectations. So I don't think that was it. Let's head over to the US and see if there's anything really terrible over there, and certainly not in the Conference Board Consumer Confidence Survey. We saw that come in at 89.3, and that was a little bit better than expected, and certainly up on the previous reading. It is flatlining down there, but nothing too terrible in that to worry about. The expectations index popped up, so that's always nice as well. That's forward looking. Having a look at durable goods orders. Now, this is a really key economic piece of economic data for me, and that was weaker than expected, 0.2% increase compared to the 0.9% expected, and that is continuing a bit of a downtrend here. But once again, probably not enough to spook the markets. GDP came out in line with expectations, that's fine. And Jerome Powell from the Federal Reserve, his comments were largely in line with expectations as well. Nothing really rocking the boat there. And of course, as expected, US interest rates on hold. The Purchasing Managers Index for Chicago heading in the right direction, still showing a V-shaped recovery, and weekly unemployment claims coming down and better than expected as well, and continuing claims down by about 200,000, bringing us below 5 million for the first time since the start of the crisis, all pretty good. Inflation was a little bit higher than expected, but at 0.3% for the month, not getting anybody too riled up at this point in time, and the personal income and expenditure numbers were pretty close to expectations. If anything, the income number was well ahead of expectations. So, long story short, nothing really in the economics either to give us rationales for why we fell last week. I think it's a combination of small factors building up to markets just swinging to be a little bit more cautious, a little bit more risk off. I don't think the GameStop fiasco helped during the week. There was plenty of talk of of markets being in a bubble prior to last week. That's pretty common as well when markets are going up. There's always people, naysayers, talking about bubbles. But maybe GameStop just caused a few people just to take a step back and just review their bullishness at this point in time, and maybe think about applying the cash that they have. There's still plenty of cash on the sidelines, but applying that cash at lower prices rather than these current relatively high prices. Have a look at the broker upgrades, downgrades during the week. Just looking for themes here more than anything else, and anything interesting that pops out. Certainly Credit Suisse on a couple of travel stocks. I thought it's quite interesting here on corporate travel management, CTD, and Webjet with an upgrade from neutral to outperform for corporate travel, and then neutral to outperform for Webjet, and big price target increases. So a 57.1% price target increase for corporate travel management, and still allowing about 32% upside in that share price, and then Webjet up about 46% and still about 13% upside for that one. Other than that, much of a muchness. If you've got one of those stocks, I guess you're pretty happy with the upgrades. There were certainly themes in the downgrades though, and apart from Computershare, which was downgraded from buy to neutral, over at UBS we saw downgrades for mainly materials, mining and energy stocks. So IGO, that's the nickel miner, they came out with a quarterly update which was quite disappointing. So we saw outperform to neutral on that one, but the price target did edge higher from Credit Suisse. Iluka Resources, which is the mineral sands company, that went from neutral to underperform. Mount Gibson Iron, obviously an iron company, downgraded from buy to neutral at Citigroup. Orocobre, which is a lithium company, got downgraded at both Citigroup and Credit Suisse, but I do note quite large price target increases from both of those. Sierra Resources, which is that battery graphite play, also got downgraded. Woodside, obviously energy company, and then Western Areas, another nickel company, downgraded, and they had quite a shocking update actually, with lower production than expected and rising costs as well. So downgrades for many miners there, but I do note for the most part the price targets were increased, with the exception of Western Areas, where they were not only downgraded but the price targets were decreased as well. But a little bit of a theme there with maybe mining companies. They've had a fantastic run, and the brokers are starting to get a little bit more cautious on them. Looking at the value in the Australian market, or if there is any, and with a PE of about 19.33, it is very, very high. Typically, when you're starting to get over 20, you're starting to call that market expensive. Certainly, if you look at developed markets around the world, they would be classified as expensive. So, the good news is we're a bit cheaper than those, but still, quite elevated in terms of our valuation. So prices have come down. That sends the PE down. We need earnings to go up to make it come down further and show that our market is better value. Looking at the individual sectors, the materials sector continues to be the best value out there, followed by the financials, property trusts, and then the rest really. The technology sector continues to be the most expensive, at 69.5, and that is well up from about a month ago. Having a look at some of the technical insights here, and what we're checking is the performance of each company's shares versus their moving averages over 1 week, because there are typically 5 trading periods in a week, and then out to 1 year, because there's about 252 trading periods over the year. Now, last week, that's the yellow line, we were looking pretty good, and I was getting quite excited about the fact that we were pretty much at the green line, which is the all-time highs for the market in terms of the stocks participating in this rally. It's the stocks showing uptrends over, really a very broad spectrum of time. The pullback last week has put a major dent in that. We're now only showing about 30% of the ASX200 stocks with a 1-month uptrend. It does improve from there as we get to the longer term trends. So the damage is limited to the sort of short to medium term trends at the moment, and we certainly don't want to see these long term trends start to turn around, because that would be it would not be good at all for the market going forward. We are still well off, however, the worst of the worst back in March last year. Okay, having a look to the week ahead, it will be a big week this week for Australia because we do have our interest rate announcement and then a couple of speeches by our Reserve Bank Governor Philip Lowe, one there on Wednesday and then one at the end of the week, and markets will no doubt be looking at those very closely. Looking around the world, we do have a bunch of manufacturing data out, don't we? So manufacturing PMIs for China, then Europe, and then the US heading to the next page. And then we see the corresponding services PMIs come out during the week. We will have some inflation data there for Europe. And closing out the week, we will be seeing employment data for the US. That is the, without a doubt, the single biggest data release each month, the non-farm employment change. And the previous reading for the US economy was it lost 140,000 jobs. We're hoping that we're going to see about 55,000 jobs created for the month of January. Apart from that, fairly quiet apart from those PMIs and retail sales in Europe. And that's about it. Yeah, I don't think there's anything apart from the non-farm payrolls that's to market moving in there. Okay, well, that's it for us today. Quick whip around and checking out what's happening. If you want to join in with our various news and research updates, tune in to the market news section. The link is up the top. You can follow me or the Think Markets handles on Twitter. On Wednesday, we have a webinar which is entitled Ask the Experts, and you get to bring your portfolio along and ask me for a quick analysis, fundamental, technical, on those stocks. Now, you must register for the Ask the Experts, so head to the market analysis page on the home page on the website and go to the webinars tab and register details. And then if you like, you can register for the 3 small cap stocks to watch in 2021 on the 10th of Feb. And, if you like, the next Ask the Experts as well. Now, the disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker, and we do have some products that could see you lose more than your deposit. So it's important you understand these details here. If you're in doubt on anything, please give us a call or consult the website for further details. That's it for me this morning. All the best for your trading until we catch up again. Bye-bye for now.